Assalamu alaikum, my dear students, I hope to be fine. In this lecture, I am going to talk about the most interesting topic, which is investing in stocks and bonds. Firstly, we will talk about the main features of stocks and bonds. In this regard, we should understand main issues including cash flow rights and maturity, legal relationship between the issuing company and the holder of each security, types, other features, and valuation. To understand the difference between stocks and bonds much better, we suppose that there is a dialogue between one of you as an investor and a financial advisor who works in a brokerage company. You begin this dialogue with a question: what do you mean by stocks and what do you mean by bonds? Your advisor told you if you buy common stocks, you will be owner in the issuing company. So if you bought 100 shares of Telecom Egypt, you become owner in Telecom Egypt company. Most companies issued their shares at par value. Say, if Telecom Egypt issued their stocks at 10 Egyptian pounds for each share, so your equity will be recorded in the financial statements of Telecom Egypt, your shares equivalent to 1,000 Egyptian pounds. You bought 100 and the par value of each share is 10 Egyptian pounds, so your equity is 1,000 Egyptian pounds. But if you buy a bond, you will be lender to the issuing company, which means you will have a claim on this company. If you put most bonds or issued at face value of 1,000 Egyptian pounds if it is issued in Egyptian stock exchange. So if you bought just 10 bonds, you have a claim of 10,000 Egyptian pounds on the issuing company. So if you buy a bond, you will be lender, you will be creditor, and the financial company has financial obligations for you equals this amount. How I can buy it? The investor asks his financial advisor how this investor can buy stock or bond. The advisor told you can ask my brokerage firm to buy on behalf of you. So the brokerage company will buy the required number of shares at market price in stock exchange, stock market in which shares of Telecom Egypt and other companies are traded. And in the same way, if you want to buy specific number of bonds of any issuing company, you can ask brokerage firm to buy on behalf of you, and the brokerage firm will buy the required number of bonds at the market price in stock exchange. Stock exchange, call it stock market, which is a capital market. So, what kind of cash flow you will receive if you buy stock? If you buy stock, you will receive cash dividends. Why? Because you are owner in this company. So you will take at the end of each period % of net income. But if the board of directors of this company decided to not distribute cash dividends this year for any purposes, because they will do expansion in the business, or because they will repay large portion of their debts or other purposes. There is no legal obligations for you against the company. But in case of bond, you are creditor, you are lender, so you will receive interest like bank. In case of granting this company loan, the bank will receive interest payments. You will receive interest payments like the bank. The bank play as a creditor on the company, and you also as a creditor to the company. So you will receive interest payments from the issuing company if you bought its bond. Interest is calculated as percent of face value. Usually is a fixed coupon rate, and you have full legal obligation against the company if it defaulted to pay the interest payment at the specified date. When you will receive cash flow? Actually, if you buy stock, you will receive non-periodically dividends. It's up to the decision of board of directors to distribute 20% of net income, 30% of net income, or not to distribute any cash dividends. And if they distribute cash dividends this year 10%, there is no condition to distribute the same percent next year or above or below. So you may receive constant dividends or constant growth rate of dividends. Your dividends may increase by 5% annually, or non-constant growth rate. Your dividends increased from year to year, but at non-constant growth rate. In case of bond, usually you will receive periodical fixed coupons. It may be annual coupon payments or annual interest payments, semi-annual coupon payments, or quarterly coupon payments. Most bonds pay semi-annual coupon payments. As we said before, the coupon payment is calculated as a percent of face value. Most bonds issued at fixed coupon rate, but there is some bonds issued at floating coupon rate, and some bonds issued at zero coupon rate, which means it issued at discount, like treasury bills. Okay, how long I can receive cash flow? It depends on the life of security. In case of stocks have infinite life, but bonds have limited maturity. More specifically, if the bond has maturity of more than 10 years, it is called bond. But if bond has maturity of less than 10 years, it is called notes, not bond. What types of the issuing institutions? In case of stocks only issued by companies, corporations. But bonds can be issued by governments, and they call it treasury bonds, and they can be issued by companies, and they call it corporate bond. Can the stockholders and the bondholders have rights on the issuing company other than cash flow? Yes. Actually, stocks have voting rights. Voting rights means you can vote as a stockholders. You can vote on critical decisions, like if your company want to do merger or acquisitions. You can vote on these critical decisions. But if you are a bondholder, you don't have any voting rights on such critical decisions. But you may have covenant. Covenant is restricted rules or limited actions on board of directors, like dividend ratio and debt ratio, by which this covenant, which is restricted rules, restrict or obligate the board of directors of the issuing company to don't exceed dividend ratio, specific dividend ratio, like 40%. The board of directors cannot exceed 40% of dividend to stockholders, because they issued bonds and they agree with bond holders about the dividend ratio doesn't exceed 40%. And by the same way, debt ratio. For example, the board of directors can be obligated to don't give any extra loans above 30% or 40% of capital structure. So this restricted actions called covenant, and some issues of bonds give bondholders this right. What if the issuer bankrupted? In case of stocks, if the issuing company bankrupted, it will sell its assets. So it is called liquidation. You have a residual claim on the company's liquidated assets. Residual claim means you are the last part receiving his claim or his equity in the company, which means in case of liquidation, the company will pay firstly banks. It will sold its assets and pay first of all bank loans, and then it will pay bond issue, and then it will be pay for preferred stocks, and the remaining amount of liquidated assets will be distributed for stockholders, common stockholders. So you have a residual claim. But in case of bond and the issuing company is bankrupted, the liquidated assets will be distributed first for bank loans and then for bondholders. So bondholders have seniority in receiving their claims than stockholders. Other features of common stocks. Common stocks may or may not be issued with par value, and shares of public companies traded on stock exchange. So there are two types of corporations: privately held corporations and publicly held corporations. Privately held corporations means the ownership of this company is owned by a few number of shareholders, and shares of this company are not traded and are not listed on a stock exchange. But publicly owned corporations, its ownership is owned by a large number of shareholders, and their shares are traded on stock listed and traded on stock exchange. The corporations can issue several classes of common stocks. Each class has its specific cash flow rights and voting rights. There are other features of bond called bonds with embedded provisions. The first provision is called conversion provision, which gives the bondholder the right to exchange the bond for a specific number of shares. For example, one bond of 1,000 Egyptian pounds face value can be converted to 150 shares of the issuing company. So if you have a bond issued by Telecom Egypt and its face value is 1,000, you have conversion provision on this bond to convert the one bond into 150 shares of Telecom Egypt. The second provision is call provision. Call provision gives the issuer or the issuing company to buy back the outstanding bond. If the bond has 1,000 face value, it can buy or call this bond of 1,000 face value from the bondholder, but at a pre-specified price called call price. For example, it can buy back 1,000 face value bond at 1,050. So bondholder will get 50 Egyptian pounds as call premium. Put provision give the bondholder the right to sell back the bond of 1,000 face value to the issuing company at a bought price. Usually, bought price is set at lower price of face value. If the bond market price reaches this price, the bondholder can sell back this bond at 850 because of the possibility to decrease less than 850. In the last slides, we talk about features of common stocks and features of bonds. But there is another type of stocks called preferred stock, and sometimes it is called hybrid security. Why? Because preferred stock has some features of common stocks and some features of bond. First of all, preferred stocks means this stock has preference on common stocks in receiving dividends and in receiving their equity in case of liquidations before common stocks. First of all, preferred stock has cash flow, fixed cash flow. Preferred stock provide its holders fixed dividends, which is similar to bond in providing fixed income in form of interest payment. So preferred stock has these features like bond in providing its holder a fixed income. But this fixed dividends doesn't mean the preferred stockholders have legal obligation for this dividends, which is similar to common stocks in providing dividends. So preferred stockholders haven't legal obligations against the issuing company in case of doesn't paying dividends. Preferred stocks can be cumulative or non-cumulative of missed dividends. Cumulative means if the firm this year doesn't pay preferred stock dividends, and the next year it will pay dividends in arrears, which means it will be pay dividends for the last year and for the current year. Non-cumulative of method dividends, if the firm in this year doesn't pay dividends, and in the next year it will pay the dividends for its current year only. It will not pay any dividends for the last period. As we said before, preferred stocks have a higher claim on liquidated assets and the claim for any unpaid dividends. But preferred stocks have no voting rights like common stock holders. Common stocks have voting rights, but preferred stocks have no voting rights and have no ownership. Preferred stock issued with assigned par value, but common stocks may issued at par value or may issued at no par value. Preferred stocks have some features of bond, like it can be redeemable at pre-specified price, like call provision in bond. And preferred stock can be convertible into specified number of common shares, like conversion provision in bond. Preferred stock can be issued in several times, so it is called multiple preferred stock issues or rounds, like common stocks. One firm can issue different classes of common stocks, class A and class B. For each class, the owner or the shareholders have different cash flow rights and voting rights. My dear students, in this lecture we will introduce part 2 of investing in stocks and bonds. We will talk about valuation of bonds and stocks briefly. If you go to the marketplace to buy some asset, you will buy this asset at what is known market price, current market price. In this slide, we want to differentiate about market price of any asset and its fair value or real value of this asset. As you know from principles of macroeconomics, the market price of any asset can be determined by demand and supply in the marketplace. So market price of any asset is determined by demand and supply. For example, if you go to buy some asset and which is traded at 12 Egyptian pounds in the marketplace, the first questions in your mind, is it worth 12 Egyptian pounds? This questions is the basic idea behind calculating fair value of any asset. To search about fair value or real value of this asset. The basic model and the most acceptable model used to find fair or intrinsic value of financial assets take in consideration 3 factors. The expected cash flow from this asset over the time period you will invest or buy this asset and hold this asset, and take in consideration the risks associated with investing in this asset. So if you want to buy or if you invest in any project, first of all you will easily find its cost in our exercise 12 Egyptian pounds, but is it worth? I will, in other words, what the benefit from this asset equals 12 or more. So you have to calculate fair value or intrinsic value of this asset. What if you find fair value of this asset differ from the market price, either above or below the market price of 12 Egyptian pounds? So we have two cases. One case, if the fair value less than market price, and second case, if the fair value is greater than the market. So the first case, market price is 12 Egyptian pounds, but you estimated the fair value of this asset, and we find this asset should be, or its real value equals 15 Egyptian pounds. So investors in the market buy and sell this asset at 12, but it's worth 15. So those investors undervalue this asset because they buy and sell this asset at a price less than its real value. So this case, in which value of 15 is greater than price of 12, is called undervalued stock or undervalued asset. Okay, your decisions, invest in this asset or not. You will invest. In the case of stocks, you will buy this stock. Why? Because you recognize this asset is underpriced. Investors in the market doesn't know its real value. So if you buy at 12 today, you expect to increase from 12 to 15 Egyptian pounds. So you will get or achieve return or capital gains. The second case, if we find fair value of this asset or this stock is 10, which is less than its market price, so investors agree to demand and supply this stock or this asset as 12, but it's worth only 10. So investors overvalue this stock or this asset because they buy and sell at 12, but its real value is 10. So your decisions not buy, but if you actually hold this stock, you will sell it because you expect that this stock price will decrease from 12 to 10. Okay, but if the price equals the value, it is called fairly valued stock, and your decisions if you have this stock hold, and if hold it, and you will not buy much more shares because it is fairly valued till new information flow to the market. If it is positive information, you will buy more shares because you will expect a price to increase. But if you bad news or bad information flow to the market, you will sell your shares because you expect to decrease in the future. Okay, let us know how to do valuation of stocks and bonds. Actually, valuation of bonds is relatively straightforward and less complex than stock valuation. Why? Because bonds has limited period of time over which you expect to receive coupon payments at the end of each time period, and at maturity you expect to receive your principal wealth, principal value of this bond which is called face value. So at the maturity you will receive face value. Maturity 10 years, 15 years, 20 years. So you know, at after 20 years I will receive my face value of this bond. So you know the time, a bond has limited period of time. The second, predictable cash flow. You know how much you will receive at the end of each time period specifically, and at the end of the time period you expect to receive fixed amount of face value. But common stock valuations is more complex process, because common stocks have infinity life, infinity time period, and predicting the performance of any company, it's a more difficult task, and the financial analysts compete each other to predict how much this company distribute next year, and for the over the next 5 years, growth rate of dividends from year to year. So this is a difficult task, and financial analysis provide different reports with different values, but of course they provide near values, but doesn't the same amount or the same values across different analyses. The basic model can be used to value stocks and bonds is the discounted cash flow. Discounted cash flow, it's a basic valuation model. Take into account the time value of money. The timing of cash flow affects its value, and from its name, discounted cash flow involve is finding the present value of the all expected cash flow over the next time period using required rate of return as a discount rate. The basic equation of discounted cash flow equals V denotes value of asset, either stock or bond, equals present value of expected cash flow. So we will divide each periodical cash flow by 1 plus R, which is rate of return. So we have three variables in the equations of discounted cash flow. The first one, the expected cash flow or periodical cash flow, and it over how many periods. So we have to find the time period, which is N, and at which we will discount these cash flows by using rate of return. It is called required rate of return. We will use required rate of return as a discount. So these equations of discounted cash flow actually differ across different assets, from stocks and bonds, preferred stock and the common stocks, because each security has unique or specific cash flow forms. So in common stocks, the first form of cash flow is expected dividends, annually expected dividends the investors will receive for the next specific number of years. The second type of cash flow or form of cash flow in case of investing in stocks, common stocks, expected selling price. If you expect to sell this stock after a specific period of time, so you will you have to take in considerations this price in calculating the value of the stock it should be today. So the equations simply will convert from the standard form equations of dividing cash flow at the end of each period by 1 plus discount rate power n into the equations in which we will substitute cash flow as dividends at the end of each period, and expected selling price at the end of the investment period. You expect to sell this asset or this stock at some value, so we will discount this value by dividing this value by 1 plus r power n. If you expect to sell this stock after 5 years, so n will be 5. If you expect to sell this stock after 3 years, so n will be 3 years. And the first terms for discounted periodical dividends, either constant dividends or variable dividends. Variable dividends means in this dividends differ from year to year. Constant, the same amount of dividends are expected to be received at the end of each year. In case of preferred stock, as a definition, preferred stock provide fixed dividends, and preferred stock, like common stocks, has infinity life, infinity time period. So fixed dividends tend to be perpetuity dividends. So we will use simple equations of present value of perpetuity as discussed in present value of annuity lectures by dividing the fixed amount of dividends by the discount rate or the rate of return. But in case of bonds, we have two types of cash flow. The first one is periodical interest payment. Bondholder expect to receive at the end of each period coupon, in most cases fixed coupon payment, and at the maturity date he or she expects to receive the original principal of this bond, which is called face value. So we have two types of cash flow. So we will modify the standard form of equations of discounted cash flow to take in considerations the interest payment at the end of each period. So we will discount each one, plus the discounted value of future value or face value after a specific time period or at the maturity date. We will discount FV for face value at the end of the time period. So if the maturity is 30 years, so we will n should be 30, and we will divide the face value at n 30 by 1 plus r power 30. Let me show an exercise about common stock valuation. Our exercise talk about some investor who want to invest his money by buying shares of Telecom Egypt stock. His financial analyst told him about the company announced to distribute cash dividends of 1.8 Egyptian pounds per share for the next 4 years. So this investor expects to receive at the end of each year 1.8 Egyptian pounds. So he expects to receive equal annual cash dividends for the next 4 years. If he buy and he wants to decide to buy or not to buy this stock today. Also, he speculates or expects that this stock can be sold at 25 Egyptian pounds 4 years from now. So this investor expects to sell this stock after 4 years at 25 Egyptian pounds. And he requires rate of return 15%. He requires rate of return 15% to buy this stock and hold for the next 4 years. The first required is what is the value of common stock should be today. So you asked about to estimate how much is this stock worth today, given this information about receiving 1.8 at the end of each year, and you expect to sell 25 Egyptian pounds at the end of 4 years. So you expect to receive two types of cash flow. The first one is cash dividends, and the second one is selling price. So how much is this stock worth today? We can estimate by using the discounted cash flow model, by which we will discount each cash flow expected to be received over the next 4 years. As we said, we have two types of cash flow. First one, cash dividends, periodical cash dividends, and selling price at the end of the period. So we will calculate the present value of periodic cash dividends plus the second type of cash flow is the selling price. So we will calculate the present value of expected selling price at the end of year 4, so after 4 years. Okay, you know that this investor expects to receive 1.8 at the end of each year for the next 4 years. So he expects to receive equal periodic cash flow, which called annuity. So instead of applying the traditional equations by dividing expected dividends at the end of year 1 plus divided by 1 plus required rate of return power 1, and dividing expected dividends at the end of year 2 by 1 plus r power 2, and so on till dividends at year 4 plus 1 r power 4. We expect to receive the same amount for the next 4 years, so we can apply equations of present value of annuity for what? Cash dividends plus present value of selling price, because we have a second form of cash flow, which is expected price at the end of year 5. So remember, present value of annuity, that is BVN, equals the single amount of cash flow, in our case cash dividends, times present value interest factor for annuity. This factor can be obtained from table or applying the equations. We will apply the equation. So present value of annuity equals cash dividends, the single amount is 1.8 Egyptian pounds, times present value can be obtained by applying this equation, plus R in our case is 15% bar 4 for the next 4 years, divided by 0.15. So we will get 5.14 Egyptian pounds. So we expect to receive 1.8 at the end of each year for the next 4 years, and we want 15% as a rate of return or discount rate. So this amount, all the 4 cash dividends received for the next 4 years, it worth today 5.14 Egyptian pounds. So value of stocks will be 5.14. It is a present value of cash dividends plus present value of the selling price. We expect to sell this stock at 25 after 4 years, so I will discount this amount to be worth today how much by dividing future value by 1 plus r 0.15 bar 4, so we will get 19.43 Egyptian pounds. So this stock fundamentally should be equals 19.43 Egyptian pounds. But if you know this stock is traded in the stock market at 15 Egyptian pounds, and this stock should be 19.43. This is a case of overvalued or undervalued, overvaluation or undervaluation. Market price is less than intrinsic or fair value of stock, because this is 15 less than 19.43. So market price undervalue, our investors in the market undervalue this stock. Stock's real value is 19 Egyptian pounds, but investors in the market agree to buy and sell this stock at 15. So investors in the market actually undervalue this stock. So the new investors should buy or invest in this stock. Why? Because this stock is expected to increase from 15 to its real value of 19.43 Egyptian pounds. So when many investors recognize this fact of this investor is undervalued, actually, they begin to buy this stock. So as you know, increase in demand on any asset will increase its price. So theoretically it is expected to increase from 15 Egyptian pounds, which is current price, to 19.43, which is real value or intrinsic value or fair value of this stock. So the investment decisions should be buy. If you hold this stock, actually you hold shares in this stock, you shouldn't sell this stock because it is expected to increase from the market price of 15 to reach its fair value of 19.43. The second exercise is about preferred stock valuation. Suppose Alex company's preferred stock gives 2 Egyptian pounds per share annually, indefinitely. You require a rate of return of 13% to buy this stock. How much are you willing to pay for this stock today? So you are asked about the fair value, or how much this stock worth today. In addition, if it is traded at 18 Egyptian pounds, should you buy this stock or not, and why? As we discussed before, preferred stock valuation take in consideration that fixed income or fixed dividends will be received by the investor or by preferred stockholder. So we will apply the equations of perpetuity of annuity. Recalling the equations of perpetuity, we can find present value by dividing the fixed amount we expect to receive divided by R. So investors or the preferred stockholders expect to receive the same amount at the end of each year. In our case, the investor expects to receive 2 Egyptian pounds at the end of each year indefinitely. So we will divide. So we have a case of perpetuity cash dividends. So we will divide the cash dividends expected to be received at the end of each year divided by the required rate of return by investors. Current rate of return required by our investors is 13%. So 2 divided by 0.13, we will get 15.4 Egyptian pounds. Okay, so this stock is worth fundamentally of 15.4 Egyptian pounds. But if you know, this stock is currently traded at 18%, 18 Egyptian pounds. So its market price equals 18 Egyptian pounds, and it should be 15.4 Egyptian pounds. So we have a case in which market price is greater than fair value of this stock. So this stock is overvalued or undervalued. Investors in the market agree to buy and sell this stock at 18 Egyptian pounds. However, its fair value, its intrinsic value, its real value should be 15.4. So market overprice this stock. Investors in the market overprice this stock. They accept to pay more than it worth. So this stock is overvalued, and the investment decision should be not buy for a new investor, and if you hold this stock, you should sell. Why? Because we expect that this stock will decrease from 18 Egyptian pounds in the market to 15.4, which is its real value or its fair value. The third exercise in our lecture is to find bond value. How to find bond value or bond valuation. Suppose outstanding bond of Golden Company pays 7% annually coupon interest rate with 1,000 face value, and remaining years to maturity is 15 years. Market interest rate is 8%. Calculate the bond value. Okay, recalling from the discounted cash flow model, in which we will discount all expected cash flow we received over the next time period. In our case is bond. Bond, as we discussed before, gives two types of cash flow. Coupon payments or interest payments, and at maturity the bondholders will receive face value, the principal value of this debt. So value of bond should be present value of all expected coupon payments or interest payments over the next 15 years plus present value of face value at the end of the 15 years or at the end of maturity. Okay, we expect to receive how much interest? 7%. 7% is coupon rate. It is a fixed in most bonds. 7% of what? Of the principal value of debt. In our case, it will be 1,000, which is the face value of bond. So the interest payment should be face value of 1,000 times the coupon rate, which is 7%. So you will receive $70 at the end of each year. for the next 15 years. Because we will receive equal cash flow of $70 for the next 15 years at the end of each year, so we have the case of annuity. So we will use present value of annuity equations, in which we will multiply $70 by BVEIF factor. So we will apply directly 1 minus 1 divided by 1 plus R in our case will be 8%. Why? Market interest rate in the market should be used as a discount rate, because you can instead of buying bond, you can deposit at 8% in the bank. So 8% as opportunity cost, as a market interest rate, can be used as a required rate of return in our equations. So we will use 8% by how many years? 15 divided by 0.08 plus present value of face value 1000 will be received at the end of 15 years. So we will discount this single cash flow received after 15 years by dividing the future value by 1 plus R power number of years of 15 years. So we will get 469.7. This is the present value of all coupon payments of the 15 coupon payments will be received for the next 15 years, plus 463.19, which is present value of 1000 will be received after 15 years. So bond price should be $932.89. So bond value should be $932.9. You know that face value of 1000 is greater than bond value of 932.9. In this case, bond is called discount bond. Why? Because it is traded, or its value less than face value. Thank you.